We are living through a historical time. I have been highly focused on gold, for a lesser part silver, since 2009. The last couple of years being exceptionally interesting because we've seen prices double in gold in an unprecedented way. And now we can say, well, this is normal, but it wasn't 2 years ago. I believe that gold almost has only one way it can go long-term over time, and that's moving higher.
2024 has been a remarkable year for gold, with its price exceeding initial forecasts significantly. Last week, the value of gold reached a new high, surpassing $2,500 per ounce. Since the beginning of the year, gold has risen by $449.28 per ounce, reflecting a 21.78% increase, as tracked by a contract for difference, CFD, monitoring the benchmark market for this commodity. In a notable development, gold futures have achieved a new record closing price of $2,533.60, following Federal Reserve Chairman Jerome Powell's influential speech at the Economic Symposium in Jackson Hole, Wyoming. Powell's address, which suggested a shift in monetary policy, has created ripples across various financial sectors, impacting both precious metals and U.S. equities. Gary Wagner, executive producer at goldforecast.com, believes we are currently in the midst of a major historical bull rally for gold. While Wagner acknowledges that the market may experience corrections from time to time, he maintains that the overall trend remains strongly bullish. He highlights that the Federal Reserve's recent minutes, which reveal a consensus among officials on the need for rate cuts, signify a notable shift in policy from a restrictive to an accommodative stance. Traders have fully priced in a cut for next month, with a 69.5% chance of a 25 basis point reduction and a 30.5% chance of a 50 basis point cut, according to the CME FedWatch tool. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
We're obviously in the midst, probably more than the beginning of a major bull rally, a rally that is historical in nature, in that since April, we've made, I believe, 4 record new all-time closes. And that is startling when you consider that. We're above 2,500. As you said, we're down a little bit today. But I look at this as it was a necessary and needed aspect to gold because it had been going up so strong, so fast for so long without releasing the steam, so to speak. It worried me that we could see a really strong correction. This is what we want to see, in my opinion. But we are in the midst of a historical bull cycle that has taken gold above $2,500 per ounce. I believe that there is definitely steam left, although at any moment, for any reason or no reason at all, we can see the market correct. Of course, we have a speech by Chairman Powell tomorrow at Jackson Hole. So market participants are going to look for more insight into what the Fed will do in the future. The minutes were released this week. And so for that reason, we've gained tremendous insight in that the vast majority of Fed officials believe that it is appropriate at this point to begin cutting rates. And to me, what is most important is not that they're signaling a rate cut in September. It's much more than that. They are signaling a major pivot from a highly restrictive to a highly accommodative monetary policy that's end goal is interest rate normalization. And so what I mean by that is it's not a matter of cutting rates by 1/4 or 0.5% in September. It's a matter of their goal that they have laid out in the Summary of Economic Projections, the SEP, that includes the dot plot. And if you look at the March and the June editions, the March was looking for a total of 3 rate cuts this year, a series of rate cuts through 2026, taking us from current levels, which is 5.25 to 5.5, down to what they're calling normalized rates, which used to be 2%, but now they've kind of raised that to 3%. So they're going to want to reduce it by about 2 full percentage points, from about 5.25 to about 3.25 is my sense, and do it over the next 3 years.
The dollar's performance is worth noting, as it experienced a sharp minus 0.83% decline on Friday, resulting in a minus 1.69% weekly decline. This took the dollar index its lowest value this year. The dollar has slid from representing more than 70% of the world's reserve currency in 2000 to less than 60% today, while gold reserves have risen sharply since the Great Financial Crisis in 2008, according to the International Monetary Fund. Wagner notes that as long as countries, such as the United States, continue to spend more than they generate in GDP, the value of their currencies will diminish, which in turn will sustain or increase gold's value. He expects this trend to continue for decades, making gold a prudent investment. He advises investors to consider accumulating gold and silver, whether through physical purchases or trading instruments like ETFs. Timing the market is less critical than having a strategy to buy and hold gold, as long-term trends suggest that gold prices will continue to rise. Time to watch the video and uncover more insights.
The last couple of years being exceptionally interesting because we've seen prices double in gold in an unprecedented way, and now we can say, well, this is normal, but it wasn't 2 years ago. I believe that gold almost has only one way it can go long-term over time, and that's moving higher. And the reason I believe that is not many countries, if any country, is having a budgetary restraint based upon what they have in their coffers. In other words, Keynesian economics means that when an economy is not moving as quickly as they wanted to, when we could face a recession, we print more money. We really devalue, whether it's the dollar, the yen, the Swiss franc, the British pound, the euro. We depreciate the buying power of that currency as well as the value of that currency by virtue that that country is spending more money than it has and their national debt is growing. As long as countries operate with those constraints, gold has to become more valuable because A, there is an intrinsic value, and B, it is tied to underlying currencies. And so as long as, and we'll say the example of the United States, as long as they're spending more money than their GDP, than they're taking in, the buying power and value of that dollar has to continue to diminish, which means that gold will at least have to be steady to higher. And so I think that's going to continue for decades. I don't see that changing, which means that all investors should at least be aware of how they can participate in accumulating gold and silver on a physical basis, on trading it, whether it's electronically traded funds like GLD or SLV. The key is this: the fundamentals that have moved gold prices to these historical levels are still very much in play and are still exerting the force that has been moving gold higher. As long as those forces are there, we can expect that gold will either form a base at these new levels for a while and then move up, or form a base and move up slightly, but that you won't see a major top and then a multi-year correction like we did in the middle of 2011 when we first hit 1900, and then many analysts, including myself back then, thought it was going to 2000. It hit 1900. It was like to the moon. And of course, that was fear of missing out. That was the whole strategy in which you saw something that had never occurred. This is different. And the reason I believe this is different is if we think about the chart that I just pulled up, where I show the multiple times that gold challenged 2,500 and went back down, the fact that it has now exceeded that and today moved below that means that this might be the point to add, rather than having added at $2,560, the recent highs that we got earlier this week. And so for that reason, you want to buy on a downstroke, so to speak. If in fact gold over time is going to continue to rise, it almost doesn't matter, or it doesn't matter as much, I should say, buying effectively on a dip, because if gold prices are going to continue to advance to higher levels, no matter where you buy it long term, 6 months, a year from now, those prices will be in the wind and you won't be able to buy at that level. So that's why it becomes less important in terms of market timing. What becomes important is that if it continues to hold these values and rise over time, you want to have some strategy to accumulate and add to that position periodically. That would be the one thing I would tell investors to focus on.
There's no question that gold's unique investing benefits have always attracted a certain level of interest from investors. After all, gold offers unparalleled perks as an investment vehicle, from acting as a safe haven for investors' wealth to providing a hedge against inflation. Currently, gold is benefiting from expected Federal Reserve rate cuts, a weakening US dollar, and falling Treasury yields. As the rate-cutting cycle begins, silver prices are anticipated to gain momentum and align with gold's performance. How might changes in Federal Reserve policy affect the broader precious metals market? Please drop your comments below and let us know what you think. If you found this video helpful, please like it and subscribe for more. We're grateful to have you with us on this journey.